Today, we're talking about big changes in the opportunities available for dairy producers to protect their price on beef on dairy calves and cull cows, an important upcoming risk management deadline you won't want to miss, as well as the state of dairy and other commodity markets here on the Uplevel Dairy Podcast. This episode is brought to you by HighGround Dairy. HighGround Dairy provides global dairy market intelligence, insurance services, futures and options brokerage, and advisory programs to a diverse range of dairy market participants throughout the supply chain. Information shared in this podcast is for educational purposes and is not a solicitation to buy or sell commodities. Opinions expressed are current as of May 16, 2025 at 1 p.m. Central Standard Time and only represent the views of the speaker and not those of HighGround Trading unless otherwise expressly noted. We are back here on the Uplevel Dairy Podcast for our May market update from HighGround Dairy with Curtis Bosma. Welcome back, Curtis.
Yeah, it's great to be back.
Curtis, we're going to get to the markets in just a moment here, but there are some big things going on that dairy producers should be paying attention to right now in regards to DRP, LRP, some changes to those programs, and a really important deadline. And so let's kick it off with that, Curtis. Give us the updates of what's going on with DRP and LRP.
Yeah, so every year, these insurance programs such like DRP and LRP, they can update some of the rules that are in each of the programs. Right now, there's been a couple updates that have been announced for the upcoming year for DRP. There's actually an additional month that's going to be added in a lag for the billing date. Component levels are being updated to expand that for some people as well, but nothing too groundbreaking there. The big changes that we're seeing for the upcoming reinsurance year are on the LRP side of things. So historically, that LRP program has mostly been designed for the cattle and beef industry to utilize for people that are doing backgrounding with feeders or people on the finishing side with live cattle price risk. But there really hasn't been many ways for dairy producers to interact with those programs based on the typical transactions that are taking place from most dairy farms. But now that's kind of set to change here a little bit. So they're including within the LRP program the ability to protect the value of your day-old calves. So any beef cross calves that are being sold now are going to be eligible under the LRP feeder cattle program, as well as cull cows. So the ability to protect the value of those cull cows going out. So I always think when it comes to having a good margin management strategy or plan, there's three big things that we're trying to solve for dairies. Number one is the milk price. Number two is feed costs and things that we can do around that. But number three is that net herd replacement, or essentially what is the revenue you're generating from selling animals, whether that's day-old calves or cull cows, against your cost of raising and bringing replacements into the herd. And we've been somewhat limited in what we could do in terms of the financial toolkit to solve that third problem. But some of these updates to LRP have been a bit of a game changer, and we're quite excited to be rolling this out with a lot of our clients.
That is big news for our industry to have those programs updated to really be current with what is going on in the dairy industry and the value that we're driving to the beef market with those beef on dairy calves, as well as really looking at cull cows as a high impact portion of the beef market as well, especially these days with a lower national cow herd. But Curtis, this is new territory for some dairy producers looking at these margin protection programs, not just for milk, but on the livestock side here. Who's a good candidate for LRP and who might not be?
Yeah, so I think I would say most dairy producers, if you're selling day-old calves or anything like that, especially right now, I would say the timing of these updates to this program could not have been better. We have a feeder cattle market that just this past week eclipsed over $300 a hundredweight. So that when we're getting to these extremely high, record high price levels in this market, it makes a ton of sense to be able to protect this value. But I would say any producer that's starting to put together some sort of a margin management strategy or plan would be eligible for something like this. Technically, kind of anyone can use it, but I've been reminding producers of, again, that big three that we were talking about between your milk revenue, your feed cost, and then your kind of net herd replacement. This isn't the number one priority thing. Still 90 to 95% of the revenue on a dairy enterprise is coming from that milk revenue aspect of things. So I would make sure that we have a plan that tackles the bigger problems before we really get into the weeds on some of these smaller issues. But that being said, this is still a volatile commodity that is at a very high price level right now. And having the ability to work with that is very important in the grand scheme of things. And we're also approaching an important deadline here. So for anyone that, has an existing insurance policy for DRP or LRP, maybe with another provider or something like that, it's kind of that time where you say, all right, let's take a look and see, are we really getting the most out of our relationship with those providers? I think it's important for all producers to ask themselves of like, hey, am I working with an advisor that has the knowledge base, has the tools, has the network and information that's helping me make these decisions? I always like to say HighGround's a great candidate for all producers just because the futures markets are what really drives the pricing behind the DRP, LRP, and LGM programs. So if you're working with someone that doesn't have a deep understanding of what's going on in the futures market, who are the players that are moving the market one direction or the other, and what's going on behind the scenes, well, then you're missing out on a lot of the information that would help you make effective margin management decisions for your business. That's something that our team, we have access to a lot of information. We have people that are solely dedicated to just digging through data and having conversations with clients across not only the domestic dairy supply chain, but also globally. We get a lot of information that allows us to make some key decisions to help our clients out. I think on the producer side, specifically the people on our team, we tend to hire specifically from people that have some sort of a farming or ag background because, again, we see this as a legacy business. This is something that is a bit unique and we want to make sure we honor it in that way. But we also want to make sure that the solutions and the systems that we're designing for producers are customized to work for the producers themselves, whereas everyone's going to look at this stuff a little bit differently. And we want to make sure that if you don't have a plan in place, or maybe you have access to some of these tools, but you don't really feel like you've used them very systematically, we should be able to get a plan together and be able to develop some consistency and kind of overcome maybe some of those psychological hurdles that are there when making a lot of these decisions. Because again, at the end of the day, a lot of this stuff, we could do a lot of science and math to figure out if a price is good or bad, but being able to actually go through the process of making the decision and agreeing upon taking a price or protecting a price can sometimes be a bit of a hurdle psychologically for people.
Curtis, that deadline that's coming up for switching agents for the DRP and also incoming with LRP as well is July 1st. And for those that have been listening along here on our podcast and are regular listeners to you, Curtis, and familiar with your team at HighGround, anyone who wants to get more familiar with you and what you guys do and how you serve producers can certainly find the contact information in our show notes as we face that looming July 1 deadline. And to expand on what you mentioned before with the pulse that HighGround keeps on what's going on in the dairy marketplace, both domestically and globally, Curtis, let's get it straight from you, the May monthly market update.
Looking at the markets right now, fundamentally, there hasn't been a lot of major shifts taking place, but from a price action wise, we've seen a lot of movement here as of late. So just taking a glance at class 3 and class 4 milk futures, where they're at today versus where they were a month ago. We've seen for Q3 over $1 a hundredweight of a price gain for class 3 futures from where we were last month. We're back to where we were near contract highs or at contract highs for some of these months. Class 4 has seen some of this benefit as well, not quite as drastic, but it's been a steady climb there. And really quite interesting because we really, again, haven't seen much fundamental change. There's a lot of things going on, a lot of moving pieces to the markets right now. So if we just go through this and look first at milk production has actually started to see some signs of growth depending on what region you're looking at. So the March milk production report, we were up 0.9% year over year. But again, the key growth has been in regions where there's been additional processing capacity adding. So you've seen states like Texas and Idaho and others really stepping on the gas here, whereas California, Washington, some of the more West Coast states have been struggling a bit. California is still climbing out of bird flu. I know that kind of wreaked havoc a little bit. Idaho's been actually dealing with bird flu as of lately, but the new strains don't seem to have any impact on milk production. And talking to contacts in the region, there's been a lot of testing taking place here as of late, which is causing a lot of these positive cases to pop up in the headlines and in the numbers. But from a milk flow perspective, we haven't heard of any impacts out there quite yet. So we would expect the trend of Idaho being up year over year to continue here into the months to come. Looking at the specific products, like more on the product side, the four core commodities that we always like to cover, cheese has been the real mover, the real driver behind the rally here in Class 3. If we recall, basically coming out of February into March, we saw cheese prices really soften up, move towards some historically lower levels into the 160s. Now we've started to regain some of that strength a little bit. As the old adage always goes, low prices fix low prices. So we got to some lower price points. We were already somewhat competitive on the export stage against a lot of the other regions of the world. We became even more competitive when we saw some of those price declines back in the first quarter of this year. And as a result, export sales have been quite robust this far. We're seeing good numbers out of the countries that are taking cheese from us. I know we could talk about tariffs for a while, but the tariff situation, at least as it stands today, China has been put on a now 90-day pause, which opens up some of those shipping lanes for certain commodities. And Mexico being the key buyer of a lot of our domestic dairy products, nothing has changed. We're remaining status quo there. Overall, cheese exports have remained somewhat steady. And as a result, we've tightened things up a little bit. Prices have been moving higher. And with that kind of momentum gaining to the upside, we're now starting to see futures make quite a big move as well. Overall, I think the other thing to point at is, and we've touched on this before, is exports are great, but the larger piece of the overall demand for U.S. dairy is the domestic disappearance, or what we use here domestically. And that hasn't been as great. It's been holding relatively steady. It hasn't been showing any dire signs or anything like that, but we're not seeing a lot of robust domestic demand. But because of our price competitiveness, we've been able to really move a lot of cheese through the export lanes, which has helped tighten up that balance sheet a little bit. But as these prices now move up, that makes us less competitive from an export standpoint, especially if there's potential tariffs at play or anything like that. So we could talk all day about policy, but the number one thing that influences the ability to export any commodity is always going to be price. So that's been kind of something to monitor here closely of, hey, this has been a great run, but where do we go from here now that we've climbed back to the top of the hill once again? Shifting over to butter, looking at the butter market, kind of the same old story we've been saying the last couple of months where, component production on herds across the U.S., not a new trend, but we've been pretty stellar at getting that butter fat out of cows. And with that, we've had a lot of excess cream floating around, going to churns. Butter production's been very robust. Although against some of these crazy production numbers we're seeing out of butter in the dairy products report, we're not really seeing stocks swell to an unreasonable level. So that what that tells us is that demand has still been pretty steady for those things. And then again, similar to cheese, where butter here domestically in the U.S. has been competitively priced against the rest of the world. So we've been able to export some of that, but a similar thing. We don't export a ton of it. The spec of butter that we make here in the U.S. is actually different than the international spec. So everything's typically made to order. But as an importer, if the price is significantly cheaper, they'll flex a little bit on some of those things. Again, price has become the main driver and the reason why we've been able to move a lot of this product. And that's keeping that market, somewhat supportive. I think when you looked at how much excess cream was floating around in the first quarter of this year, you might have got a bit nervous that we were going to break the butter market, but we've been able to work our way through that a little bit. And then looking at the milk powders, finally seeing some signs of life. We didn't really have too much excitement to report out of either non-fat dry milk or dry whey over the last couple of months. I know we talked about how all these additional cheese plants were going to mean additional whey, and selling that whey was going to be a bit of a problem, especially with the excess commodity grade whey that may be out in the marketplace. The trade tensions between the U.S. and China were also going to be a bit of a challenge there as well. But now that we've put a pause to that, at least for 90 days, and we've started to see some international strength in terms of milk powder prices ticking higher in recent global dairy trade auctions and such, that's really keeping our domestic prices relatively supported. They're not at a price level that's necessarily going to rise the tide for the entire complex or anything, but those can also be like an anchor that drags everything down when prices are super low for those sorts of things. So It's been an optimistic period right now looking at the dairy markets because the headlines are telling us that, hey, we're back. We're back at $19+ milk in class 3. This is exciting. But I think it's important to be mindful that there's some changes taking place on the global stage and there's some challenges ahead as well.
Yeah, it's definitely been a bit of a roller coaster in 2025, huh, Curtis? Preparing for this year, going through Q1 and now halfway through Q2, it has just been all over the place with what those conversations have been based on where futures have been at, hasn't it?
I would say volatility is good job security for me, but it keeps a lot of people up at night too. It can be a little bit hectic. It's been an interesting year where we had really good margin opportunities towards the tail end of 2024 looking into 2025. Those got really tightened up to where Q2 looked like it wasn't going to be that great in terms of a bit of a rough spot here. But we fought back, and now with some of this recent price action here, we're back to where we're looking at the tail end of this year as another great opportunity for producers to secure some solid margins.
Curtis, thanks for giving us the update on what's been going on in the dairy markets. But now let's switch gears to what's going on in our commodity markets. So what have you been keeping your eye on lately?
Yeah, so planting is in full swing now. We had some hectic weather actually just over the last 24 hours here across the Midwest. But other than that, it's been pretty ideal for a lot of farmers to get the crop in this year. We've been monitoring this closely, especially with the trade tensions. There's a bit of a favorable bias to be putting in corn over beans. So the expectation was from the planting intentions report and other things that we were going to have over 95 million acres of corn put in this year. And with that, we were on a pretty good pace to get that crop in. The last WASDE report that actually came out earlier this week gave us the first glimpse at the new crop balance sheet. So looking at what this crop looks like, what the estimates are for ending stocks and production. With that 95 million acres, they're still projecting a yield of 181. I do have my questionable doubts about that. I do think over time we may see that get ratcheted a little bit lower. But that gets us a production of about 15.8 billion bushels, puts us in a pretty good spot from a production standpoint to where we would see additional potential weakness in this market. The big thing to look at there on the usage side has been exports have been quite robust this year. They're keeping exports again this year at about 2.6 billion bushels. And then that gets us down when we throw all the other usage in there of a total use of 15.4 billion bushels down to an ending stocks of 1.8 billion bushels. So that gives us, based on USDA's estimate, an average price of around $4.20 per bushel. That's a little bit softer than where we're currently sitting right now. But again, it's early in the season. These are just preliminary numbers to work with. What I also think is important to look through the rest of this WASDE report is we hyper-focus on that U.S. domestic corn balance sheet because it's the time of year where we want to see what weather and what planting progress and all those other things and how they're going to impact that balance sheet specifically. But when we look at the rest of the world, we kind of zoom out on a bigger picture. The global corn stocks are not in the same position that we are here domestically. When we talk about an ending stock of potential after this new crop comes out and all of our usage for the upcoming marketing year of dang near 2 billion bushels, it's really easy for us to look at those numbers and say, hey, this market, there's no way we're going to put a rally together and this thing is going to be quite limited. But we look at where the rest of the world is currently positioned in terms of corn stocks, there isn't the same kind of situation going on around the world. So one of the metrics that we look at with some of this stuff is the ratio of stocks to use. So looking at what the corn stocks are globally against what is used globally. And that kind of maxed out here in recent years of the 2015, 2016 crop year. We got that up to almost 28%. And if we recall back to feed prices in that time frame, they were much lower than they are even here today. And we've been whittling that down a little bit to now we're at a stocks to use ratio globally of just under 19%. So that puts us in the middle range of where we've been historically, a little bit towards the lower side even. And that is a little concerning because even if we do have a pretty good crop here domestically, it doesn't necessarily mean that global corn supplies are there to really drive this market a significant ways lower. So with that, we've been really advising clients to, hey, on these downward price moves that we've seen in the corn futures market to establish some good either cash contracts or by using futures or options to put together some plans around that as well, especially against these milk prices. Because at the end of the day, could corn go to 350? The probability isn't zero, but when you look at what you're currently presented with as a margin opportunity, those numbers are very good historically, and being able to seize those opportunities is really the name of the game when it comes to managing this stuff. Looking at the soybean side of things, again, that was not the favorable crop given everything that's been going on. Still going to see some pretty good production out of that. It's going to get us to an estimated ending stocks on the new crop of about 295 million bushels, an average price of about 10 and a quarter on those. So again, not really seeing much strength or liveliness out of the soybean complex. Again, trade tensions are going to be a challenge there ahead. They're still projecting with all the new crush capacity that's come online in recent years, it's going to keep that market relatively soft. But again, with clients on that stuff, if you see a deal, take a deal, because at the end of the day, we can wait till we see a much lower price point or we could secure the margin that we have in front of us. So it's better to have kind of a sure thing here moving forward.
Curtis, when we look ahead into the milk markets for 2025, and especially as we round out this quarter, heading into the summer as well. And speaking of summer, I hear it's been a hot one in California.
We had a little bit of a heat spell, but it has cooled off enough to justify some hopeful weekend golf plans between that and prepping the nursery for baby number 2 in my household. So we'll see if we have time for all of it, but yeah, the heat wave is coming. I think next week we're going to be in the upper 90s, so just in time for your arrival out here.
Yeah, woohoo. I'll be coming to visit you in California next week and stopping by the HighGround office and hitting up some dairies out in your neck of the woods. So looking forward to that visit. And Curtis, as always, thanks for jumping on with us today here on the Uplevel Dairy Podcast.
Yep, thank you.